The housing market is slowly transitioning to a buyer's market, with sellers dropping their prices and making concessions to sell their houses. Temporary rate buydowns are common seller concessions since they cut the buyer's interest rates for the first few years. A 2-1 buydown mortgage decreases the interest rate for 2 years and helps borrowers get lower monthly payments. A 3-2-1 buydown mortgage allows a borrower to lower the interest rate over the first 3 years of the loan. These terms may sound complicated, but this video will assist you in understanding them. 2-1 and 3-2-1 buydowns are loans that begin with a low interest rate and gradually increase in the first few years until it reaches its permanent rate. The 2-1 buydown rate is usually 2 percentage points lower in the first year and 1 percentage point lower in the second year. The 3-2-1 buydown rate is decreased by 3% in the first year, 2% in the second year, and 1% in the third year. A 5% mortgage, for example, would charge only 2% in the first year. These buydowns are frequently used as an incentive by a home seller if they are having difficulty selling their home and need to make the offer more enticing. Often, it helps the property sell faster. However, the cost comes from the proceeds of the sale of the home. Buyers, realtors, and builders can also elect to pay for the temporary rate buydown. This is a great option for home buyers, but they need to be sure they can afford the new payment once the rate increases. Here's an example of a 2-1 buydown mortgage. Assume a builder offers a 2-1 buydown on new properties. If the current 30-year mortgage interest rate is 5%, a buyer might receive a mortgage that charges only 3% in the first year, 4% in the second year, and 5% for the remaining 28 years. If the buyer took out a $200,000 loan on a 30-year mortgage, their monthly payments would be $843 during the first year. They would pay $954 in the second year. After the second year, their monthly payment would increase to $1,074, which it would remain for the duration of the mortgage. A quick reminder, if you've enjoyed the video so far, consider subscribing as we frequently upload informative and educational videos. Let's continue. Now let's cover the pros and cons of temporary rate buydowns. As mentioned before, these buydowns can help home sellers by making it easier for them to sell their homes for a good price. The disadvantage, of course, is that it comes at a cost, which eventually reduces how much they will net from the sale. Temporary rate buydowns can provide various benefits to home buyers. Buydowns can help purchasers afford a more costly house than they would otherwise be able to afford. It gives home buyers extra time before their mortgage payments increase to the full amount, which can be helpful if their income rises yearly. The downside for home buyers is the chance that their income does not keep pace with the increases in mortgage payments. In that instance, they may be stretched too thin and may have to sell the house. Now you may be wondering when to use a temporary rate buydown. Home sellers may consider offering and paying for a 2-1 or 3-2-1 buydown to attract a buyer if they need help selling the home. Borrowers may profit from a buydown if it allows them to buy the home they want at a price they can afford. Nonetheless, they will also want to consider what would happen if their income doesn't rise fast enough to keep up with their future monthly payments. Buyers should also make sure that they are getting a fair deal on the home in the first place. That's because some sellers might increase the home's price to compensate for the buydown cost. It is important to note that buydowns may not be available under some state and federal mortgage programs or from all lenders. A 2-1 buydown is available on fixed-rate FHA loans, but only for new mortgages and not for refinancing. A 2-1 and 3-2-1 buydown is ideal for a borrower whose income could increase within 2 to 3 years, a borrower whose spouse or partner will return to work in the next 2 to 3 years, a borrower who wants to reduce the cost of their monthly payment for the first 2 to 3 years of homeownership to pay for upgrades or repairs, a borrower who wants a low initial payment but doesn't want an adjustable rate mortgage. Who pays for the temporary rate buydown? Of course, someone pays for the privilege of lowered interest rates, resulting in lower monthly payments over the first 2 to 3 years of the mortgage. If not, the bank is essentially giving away money, which banks will never do. The buyer or the seller will pay for the buydown mortgage. The seller, such as a home builder, would often cover the cost as an incentive to potential buyers. Now you may be asking yourself, is a temporary rate buydown right for you? If you must pay for the buydown yourself, the important thing to consider is whether paying the cash up front is worth the 2 to 3 years of lower payments you would receive in return. You may, for example, invest that money or use it to pay off other obligations with higher interest rates, such as credit cards or automobile loans. If you have extra cash and don't need it for anything else, a 2-1 or 3-to-1 buydown mortgage may be a good option. However, as previously mentioned, going with a temporary rate buydown on the idea that your salary would improve sufficiently over the next 2 to 3 years to allow you to make the mortgage payments when they reach their maximum might be risky. As a result, you should think about how stable your job is and whether unanticipated situations may arise that make those payments unaffordable. When someone else is covering the money for the buydown, the question becomes easy to answer. In that situation, you should still consider whether those maximum monthly payments will be doable when the time comes, or if the enticingly low initial rates would induce you to purchase a more costly property and take on a larger mortgage than is financially prudent. You should also ensure that the house is appropriately priced in the first place and that the seller isn't inflating the price to pay the buydown fees. We have come to the end of the video, and we hope you have learned something about buydowns. We would like to know which one you would likely choose between 2-1 and 3-to-1 buydowns if you ever have to consider it as an option. Let us know your opinion in the comments section below. If you enjoyed watching this video, please like and share the video with anyone else you think could benefit from this content. Remember to hit that red subscribe button to catch our upcoming exciting topics.